Welcome to Mad Money. Welcome to Cramer. I'll do, my friends. I'm just trying to make a little bit of money. My job is not just to entertain, but to teach you. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. When you read about how we have such an extreme concentration of market capitalization in barely more than a handful of companies, there's a natural tendency to want to avoid them. Who wants to own stocks like the Magnificent Seven? They've had such huge runs, you can probably get something cheaper, right? But today, like so many other days, you just feel like such a chump when you deviate from these 7 stocks: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. And as we head toward the end of the year, with the Dow dipping 226 points today, S&P advancing 0.17%, and the Nasdaq gaining 0.46%, I think we may just have to accept that nothing's going to change between here and 2026. Winners tend to keep winning in the last 2 months of the year because money managers want to show their investors that they own these smart things. They might sell the Mag 7 come January, but not before then. Otherwise, they'll look like morons. So when these stocks come down, they will be bought by institutions that have lagged the averages. They are the best investments and the best ways to play the next 2 months on any weakness. So let's consider the case of Amazon. A week ago, despite tremendous derision, I defended owning Amazon on this show, a stock that had fallen behind the other 6 names in the Mag 7. Amazon's web services division was widely seen as losing share in revenues to Microsoft's cloud business, growing at about a 17.5% clip versus almost 40% for Microsoft Azure. Now, some of that alleged slowing was said to be happening because Amazon wasn't spending enough on web services. But then we got this 1 and then 2 punch for the ages. First, Amazon reported an incredible quarter, a huge uptick in the web services business, where the growth rate jumped from 17.5% to 20% off a much larger base than Microsoft. And for the second punch, if you were worried that Amazon wasn't investing enough in the web services biz, well, today we learned that's not the case at all. Amazon Web Services inked a multi-year strategic partnership with OpenAI, the one that Microsoft does all the business with, to provide infrastructure for OpenAI's advanced artificial intelligence workloads. Under this $38 billion agreement, OpenAI is, quote, accessing AWS compute comprising hundreds of thousands of state-of-the-art NVIDIA GPUs. The result? In just a few days' time, the gigantic company, now $2.7 trillion, bolts from $222 to $254, and the stock goes from being unchanged for the year to nearly up 16%. A loser? Nah. A winner.
House of pleasure.
That's monumental. Not only that, but Nvidia, which had stood still for a few days, rallies more than $4 and goes deeper into the $5 trillion zone. Now, I don't bring up this incredible Amazon gain to brag that I own the stock for the Charitable Trust, despite constant chiding and endless criticism from the bears who seem to be everywhere. No, although I do love to say I told you so. Never gets old. But no, I bring this up to refute the worries about the dangers of concentration that I heard literally, that this is what's going to cause the market to go down and hurt these stocks the most. It's all the usual arguments, like I talked about this weekend in that CNBC Investing Club think piece that I put out every Sunday that I thought was really one of my best ever, and you should get it. First, can we just accept that these stocks are not joined at the hip? I mean, really, they're joined together, but they're joined together not by the data center, they're joined by their growth. Despite their size, they're putting up some of the best growth out there. Growth. It's growth that matters to stock investors, not the data center, not accelerated computing, not even artificial intelligence. Growth is what the Magnificent Seven have in common, and growth is what the market always loves. We just don't talk about it enough. In my new book, How to Make Money in Any Market, I write that you need to be in growth stocks no matter what. That only growth stocks can measure up regardless of what happens with the real economy. These are the companies that simply aren't part of that Fed rate cut scrum. Growth stocks are the only safety stocks these days. These are the stocks that took off when the rest of the market got crushed during the mini banking crisis of 2023. They're the stocks that bounced right back after COVID. And they did that because growth is the ultimate protection in the stock business. When you realize that these are 7 companies tied together by relatively high growth rates, not by what they do for a living, you can see that there's no real worry about concentration of gains. You get their growth, you get their size. The reason why this market gravitated to Amazon last week is that it's the most valuable unit. Amazon Web Services has accelerated growth. It went from 17.5% growth, not too shabby, to 20% growth, which is rather remarkable given the law of large numbers. 20% growth of a $132 billion revenue run rate with a 34% gross operating margin, for heaven's sake. That's some of the most profitable growth the world has ever seen. Now, I want you to contrast that with Kimberly-Clark, a great company. Saw its stock get clobbered today after the company announced it was buying Kenvue. That's the maker of Tylenol, Band-Aids, Nitrogen, among other brands. We'll learn more in a second. At one time, like so many other household names, Kimberly-Clark went from being a largely domestic company to a worldwide colossus. As Western Europe, then Eastern Europe, then South America, and Asia, China, they all discovered what we knew, that gold standard was Kleenex. Kimberly-Clark's growth rate got better and better and better, and the stock was juggernaut. But once Kimberly-Clark had expanded everywhere and began to face more competition from Procter & Gamble and Unilever all over the globe, as well as the local brands that caught up to their winning formula, well, the growth rate plummeted. It got to the point that Kimberly had a 2.5% organic growth rate when reported last week. And believe it or not, that was actually a pretty good number. That's simply not enough growth, though, to attract the new buyers that are interested in the Mag 7. No wonder the company felt compelled to buy Kenvue, even as it owns the very controversial Tylenol, with all of its baggage strewn by the Secretary of Health and Human Services, RFK Jr. A company with a good yield of 4.9%, with Kimberly, with staples that are, the products that are staples. Well, didn't that used to be the ultimate safety stock, right? But as I explained how to make money in any market, that era is over. A safety stock does not go down 22% in 1 year. Of course, not all growth stocks are created equal. The questionable stocks these days are the ones that are in the data storage business. SanDisk, Seagate, Western Digital, they're now shortage stocks, meaning not enough people saw the demand for data storage coming, so they have super growth because they've got these storage machines, and their stocks are roaring higher. I like them, but I know you have to sell them at a certain point because eventually they'll pump out enough new supply to sate the demand. I am looking for stocks you don't have a buy and a sell. You just own them. I waffle on the build of data centers, too. I think they may have secular growth, meaning growth that doesn't depend upon the health of the broader economy. That's the kind of growth I'm looking for. I just don't know if they have enough of it. I feel the same way about Nucor. Got a large data center steel business, even as other customers desperately need lower interest rates. So that means Nucor's hostage to the Fed's next move. And we don't know if we're going to get a rate cut in their next meeting. I don't want to be hostage to anything. No, my growth is pure. Bottom line. When you look at the Magnificent Seven, what they have in common is not artificial intelligence, the data center, accelerated computing. It's that they all have pure, fantastic worldwide growth. And that's why professional money managers just can't quit these stocks. At the end of the day, the executives who run the Mag 7 know what we want, and they just keep giving it to us. What more can we ask for? Let's go to Venus in Michigan. Venus.
Hey, Mr. Cramer, this is Venus from Cramerica, Michigan. How you doing?
I am doing great, Venus. How are you doing?
I'm doing awesome. Hey, you're the GOAT, so I got to ask you about this stock. It recently had the bomb earnings report, and I want to know how far you think it can go. It is SoFi.
Okay, SoFi, I think, is an amazing company. I think it is run terrifically by Anthony Noto, a very old friend of now more than 30 years. I think it's resting right here, and then it's going to go up again. It and Affirm are my two favorite so-called fintechs because they do far more than what people think they do. The Magnificent Seven all have one thing in common, and that is that they have incredible growth. That's why money managers and retail investors can't quit these names, not tech, but growth. On Mad Money tonight, Kimberly-Clark announced its intention to acquire Tylenol maker Kenvue, almost $50 billion deal. But Wall Street didn't seem to care for it. I'm going straight to the source with Kimberly-Clark to learn more about what a combined company with brands like Huggies and Band-Aid would look like. Then we learned a lot about the state of the hyperscalers in last week's earnings. Go on, but I'm detailing my key takeaways. Then we thought, what if you wanted to invest in a company that isn't spending copious amounts of money on the AI build-out? I'll reveal the names I'm watching, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This morning, Kimberly-Clark, which you know is the maker of Kleenex, Huggies, Cottonelle, all sorts of other paper products, now said it's buying Kenvue. That's J&J's old over-the-counter business for just over $40 billion. Now, you know Kenvue is Tylenol, Neutrogena, Listerine, Band-Aids, Benadryl, and, of course, Johnson's, among a host of other brands. Kimberly's paying a 46% premium to create the second largest consumer packaged goods company on earth. Second, keep that in mind. But Wall Street's skeptical about the deal. Stock plunged more than 14% today in response, falling to its lowest level since 2018. It was not a surprise, though. So what's the argument for this takeover? Let's go straight to the source with Mike Hsu. He's the chairman and CEO of Kimberly-Clark to find out. Mr. Hsu, welcome back to Mad Money.
Jim, thanks for having me on today.
Okay, so Mike, why don't you give us the rationale? I know you and I talked before, and you know how much I like the deal, but I want other people to know how significant it really is.
Yeah, Jim, we're really excited today. This may be the second most important day in our company's history. Of course, Founders Day is the most important. But this is really about two great, iconic American companies joining forces to create what we think is the preeminent global health and wellness leader. And so that's really what we're trying to build.
Now, you've got two kinds of synergies. It's a glib word, but you've got both cost synergies and revenue synergies. Can you explain what both will mean? Because I think at the heart of this deal is the idea that you can boost revenues and cut costs.
Yeah. Well, here, what I'll say, Jim, is I think this is probably the single largest shareholder value creation opportunity that I'll ever experience in my career, right? And so we think there's tens of billions in value creation opportunity, of which a lot of that is driven by the synergies that you're asking about. Certainly on the cost side, I think the history is, we, having operated in lower margin categories, we run very, very lean. And so generally our overhead costs tend to be in the top quartile of the industry. I think Kenvue, in our discussions with their management, they, coming out of a higher margin pharma business, their costs are a little bit higher. And so we really believe that, we can operate efficiently with the cost structure that we have, and we can get Kenvue closer to our cost structure and operate effectively as well.
At the same time, what I thought, the thing that I felt most attractive was, in a bizarre way, you're best in certain parts of the world and they're best in others, and they tend to be a perfect fit.
Yeah, some directors would say the unique feature of this transaction is the complementarity of both the category portfolio and the geographic portfolio. And what I mean category is, hey, if you think baby, like we're coming at baby from two ends. We make diapers, they make Desinix and baby shampoo and baby lotion, Aveeno Baby. So we've invested a lot of effort to create a long-term digital relationship with consumers. And we think it's a pretty unique competitive advantage for us. We think there's an opportunity to bring other brands along that ride, along that journey.
Go ahead, I'm sorry.
On the geographic side, also, they happen to be, as you just mentioned, really strong in markets where we've struggled to drive penetration. That would be India, where they have a very big business. They're in 3.1 million stores in India, and we've had a tough time building that brick and mortar penetration. They're really big in Western Europe, multi-billion-dollar business there, and we have almost no sales in Western Europe.
Well, I mean, Procter had won, so you had thrown up the white flag. I remember when that happened. We all cheered, but that's not what you can do now. You need every inch.
Well, they have great distribution in Western Europe. They're especially strong in the pharma channel, which matters in our categories as well. They're great in the medical channels as well, and so we think there's a great opportunity to kind of expand there.
All right.
And then on our side, we are strong in markets like Indonesia, South Korea, Mexico, and where they're more lightly penetrated. And so we really think there's a big growth opportunity.
Now, do you want to get to the reservations that people expressed here? But there was one that I met Kenvue almost instantly when they were spun off. They're very nice people, and they're from Summit, where I live. But what struck me is I asked them what their club strategy was and their internet strategy was. Mm-hmm. And they didn't have one for either, which shocked me and made me say, I got to tell people to stop, sell this stock.
Yeah.
You have tremendous in both cases. Yeah. Isn't that just a great opportunity for you, both club and internet?
Channel development globally, huge opportunity for both companies, or for both of us together. We tend to be very strong in both the channels that you talk about, certainly in club in the United States. Globally, though, I would say online sales is accounting for 100% of our growth in North America this year, right? And it's because we're relatively overshared.
I'm surprised no one else asked that, but they don't know the companies as well as they should, Mike.
Our online shares are 7 points higher, 700 basis points higher than our offline shares. And so we've made a big investment to develop great relationships, a great offering, and then great. Interesting for the retailers, what they love about us is our data analytical capability. And that's what we're really good at.
Second to none. Okay, so now, the first thing I heard from people was, okay, look, they don't really understand what they're buying when they get to Tylenol. They've got a Health and Human Services Secretary against them. They have an FDA administrator who says, listen, there's conclusive data.
Yep.
They have women who are pregnant who, if anything goes wrong, they are naturally able to sue you and win, as we know that, unfortunately, it's so tragic. They will win if they sue. Now, all of these things you went through, and yet you still went through with this.
Yeah, certainly those concerns are reasonable for anyone. I will say they came out in the middle of our detailed due diligence process. And I would say we conducted a very robust due diligence process. I would say our board ensured that we brought them analysis from the world's foremost experts in regulatory affairs, science, medicine, and the legal aspects. And so, we've met several times as a board, plowing through every one of those areas and a lot of the cases. And so what I would say, Jim, is, we're aware of the situation, very aware of the situation, and we're very confident that we will create, great shareholder value through this transaction.
Now, at the same time, Texas filed a suit, which was a threatening suit, saying that Johnson & Johnson tried to get around its obligations and by offloading Kenvue, whom they knew had all these problems. Again, that I presume that they'll just loop you in now.
Yeah, we're well aware of that too, and we are a proud Texas company, and so we're aware of that situation, and we're prepared to work through that.
Now, J&J gave the international talc claims to Kenvue. I know the legal system is different internationally in terms of jackpot justice, but what did you come up with about the possibilities of having to fight all these different lawsuits individually rather than settle? And what do you think, when you discuss it with your board, is the liability here?
Yeah. Similarly, we conducted a detailed analysis of the UK talc situation, as that also came up during the due diligence process. And so we're well aware of that and have factored that into our thinking as well.
How have sales been for Tylenol since RFK Jr. got his job?
I'd say they have seen a little bit of impact, but less than you would think. And so I think the brand has been very resilient. It is, even today, while I'm still getting into it, so I'm no expert on Tylenol, but I'm told it's a very effective and safe pain reliever. And so I think the consumers respond accordingly.
Johnson & Johnson is, after trying to work with the plaintiffs' bar repeatedly for years in a reasonable fashion, decided to heck with it. We're going to fight them one by one. It has been working. Their stock went up $40 since they've done that. Would you be willing to say, you know what, we're not going to get rolled. We've looked at the science. We know there's no problems. We're not saying come and get us, but we are saying it won't be so easy for you to make money from us.
Well, and again, we are one step further removed, but we've met intensively during the due diligence process with Kirk and the leadership team at Kenvue, and we reviewed some documentation. We'd say, hey, the science is sound, and we've gotten that from our external experts as well. And so, while I won't really discuss maybe the legal strategy, but I would say, hey, we're confident in the approach, and we believe in this.
Well, there's no doubt that it's been tried many times before and found, and the plaintiffs' bar has not had great luck because it's the state of play was that it was over. It's just been resurrected because of this acquisition. Yeah. Now, tell me about. I'm sorry.
Can I just say though, coming from the company we come from, we're very, our focus, we're entrusted with like parents' most precious thing in the world, which is their baby. And so throughout our history, we've always been fully focused on taking care of our consumers. And so we would never put profits or sales ahead of the safety of our consumers. And so, I just wanted to assure you of that.
Of course. Now, Mike, I know that there have been a time, maybe in the previous administration, where two large consumer packaged goods companies getting together might have a tremendous antitrust scrutiny. Do you think that this administration might just say, you know what, you need to have a powerful competitor, Procter & Gamble, which is the way that a lot of people feel that ultimately the Google suit came down, even though that was from a judge?
Yeah. Well, I think this transaction, in addition to the big value creation, is really about two great, iconic American companies coming together creating a better future for the consumers that we serve, the employees that make us, the communities that we operate in, the partners that we work with, and the shareholders that own us. And so that's what we're really focused on. And I'm hopeful and believe that the administration across multiple countries will recognize that.
Okay, now you've got some fantastic billion-dollar brands. We've got 10 of them. Do you think there's a possibility of 15, 20, or do you want to just make these even bigger? Maybe the strategy should have each of these be much larger because the names are known throughout the world.
Yeah, fantastic portfolio of brands. I guess I have high aspirations, so I would want to make these bigger and add more. And that's kind of what the strategy is going to dictate. And we think there's tremendous growth opportunity ahead for us.
Do you think the consumer is willing to pay for brand names still, or do they want to go for, as you know well, because you've looked at it very closely, they want Kirkland's signature, or do they want these brand names that we know from our parents and grandparents? Here's
what's interesting. This is a challenging economy, and I think you've heard whatever phrase, barbell economy, bifurcation, whatever it is. We posted a fairly strong third quarter, Jim, and I think what drove that, and we had volume mix growth. That's our seventh consecutive quarter of volume mix, solid volume mix growth. I think what's driving that is, one, on the premium end, we continue to bring great innovation, and consumers that have the spending power are continuing to invest in better for you products, better products, right? At the same time, we saw this change in the environment, especially in the U.S., coming 2 years ago. And so when you saw the stimulus payments running out, and then the impact of some of the inflation that's happening to consumers, we recognized that spending power is going to be more limited. And so what we did was we aggressively moved to bring a lot of the benefits that we have in our premium tiers into our value tiers, and that's why we're growing this year. Notably, in the U.S., in our medium tier diapers, Snug and Dry on Huggies, and in our mid tier in China.
Right. But the innovation that you've brought has made it, I felt, so that they're not equal. The generic is simply not equal because of the of what you may be able to do in terms of absorption.
Yeah.
What you may be able to do in terms of things that people, as they get older, are somewhat embarrassed. Could be embarrassed.
Yeah. Whether you talk about, let's say, your generics, right, or low cost value players, and like in China, there's a lot of low-cost Chinese brands out there. Our approach, and it's the mantra, which is we are the best product, and we're going to have the lowest cost. And so we want both those, and I think that strategy is working for us.
I think that's going to be something that Kenvue very much needs, and I know you're the man to do it. I want to thank Mike Hsu, who's the chairman and CEO of Kimberly-Clark, Canby. And yes, I think this is a terrific deal because you're getting the growth you need. And as far as the lawsuits go, I've looked at them very closely, too. It's kind of been litigated, and you can ask the people from J&J, and I think they'd say the same thing. Their money's back in.
Coming up, Big Tech is going on a spending spree. Cramer's breaking down the latest CapEx on AI and the data center. Next.
So far this earnings season, we've heard a lot about the AI data center boom, especially last week when we got results from 5 members of the Magnificent Seven. Despite all the hand-wringing from AI skeptics who insist that these companies are wasting their money, the fact is that spending on the data center hasn't slowed down at all. In fact, it's accelerating. The largest companies on Earth are ramping up their AI investments and indicating that they'll spend even more next year. At this point, though, Wall Street's no longer willing to look past these massive spending commitments, which is why I want to walk you through them because they are so important. I'm a big believer in artificial intelligence as the fourth industrial revolution. And I'm an even bigger believer in the executives who run these companies. They wouldn't light their money on fire, for heaven's sake. They're spending fortunes to build data centers because, as they see it, they can't afford not to. I'm not going to question them. Let's start with Meta Platforms. Last week, Meta stock got pulverized after the company reported a very strong quarter, mainly because they raised their capital expenditures forecast dramatically. Previously, these guys planned to shell out $66 to $72 billion on CapEx this year. Now they say it's going to be $70 to $72 billion. More importantly, on the conference call, CFO Susan Lee, very straight shooter, said, our current expectation is that CapEx dollar growth will be notably larger in 2026 and 2025. People were shocked at that. While total expenses will grow at a, quote, significantly faster percentage rate, end quote, next year. mostly due to incremental cloud expenses and higher compensation costs because they're trying to poach a lot of top talent in AI. And that's why Meta stock got crushed and continues to get hit. On the other hand, Alphabet also raised its 2025 capital expenditure forecast from $85 billion all the way up to $91 to $93 billion range, much bigger increase than we saw from Meta. Yet, Alphabet stock did not get punished. Why? Wall Street seems more willing to give them the benefit of the doubt, even though CFO Anat Ashkenazi said that the company expects, quote, a significant increase in capex next year. People just said, fine. Meanwhile, Microsoft shelled out nearly $35 billion capital expenditure last quarter alone. Last quarter, not year. Much higher than the $30 billion plus number they guided for in July. On Microsoft's conference call, CFO Amy Hood said that they're ramping up spending on graphics processor units, or GPUs, the kind of chips that NVIDIA makes. Hood explained that, quote, total spend will increase sequentially, and we now expect the fiscal 2026 growth rate to be higher than fiscal 2025, end quote. 3 months ago, Microsoft had indicated that their capital expenditure growth might moderate in the 2026 fiscal year, which has already begun, but that's clearly no longer the case. Finally, Amazon raised its full-year capex guidance for 2025 from $118 billion all the way up to $125 billion. And CFO Brian Olsavsky told us, listen, the amount is going to increase next year, too. So even though only Meta stock sold off hard on heightened AI spending, the truth is everybody's doing it. This morning, Ben Reitzer sees that brilliant tech head and analyst out of Melius Research that I often quote. He put out a note saying that 2025 capex estimates for the top 4 hyperscalers, the 4 companies I just mentioned, had risen 6% after last week. And he raised his 2026 capex estimates for these 4 companies from $403 billion up to $486 billion. That's nation state money. Hey, throw in Oracle and CoreWeave, 2 more major data center builders. And now he's expecting $551 billion in capital expenditures next year and $733 billion in 2027. Again, that's just 6 companies. That's not even including OpenAI or Elon Musk's XAI, which is going to go through a lot of money itself. How do you play it? Okay, look, the most obvious answer is the same thing I've been saying for years. You just buy the stock of NVIDIA. The lion's share of the spending bonanza will go to hardware. Last week, NVIDIA held a very bullish GTC event in Washington, D.C., where CEO Jensen Huang said he has, quote, visibility into a more than $500 billion, end quote, cumulative revenue from the company's current AI chips. That's the next generation Vera Rubin chips and all the associated networking equipment. There's a reason NVIDIA shot up nearly 9% last week and it rallied another 2% today. And that's without any hope of Chinese sales, which were never in the numbers anyway. Again, though, I'm bringing this up because Meta was harshly punished for this capex forecast with its stock plunging 12% last week. Now, I think they got singled out because these numbers are giving investors flashbacks to CEO Mark Zuckerberg's expensive metaverse dalliance just a few years ago. That was before he got religion on cost controls in 2023. Now, look, I think it's possible that Zuckerberg rolled out that number to show what he's willing to spend to prevent OpenAI from competing with him on his social turf. If OpenAI doesn't make a move into social media next year, I say he can always cut back the spending. Guess what will happen then? Stock soars. Microsoft initially rallied huge in after-hours trading last Wednesday because they reported a monster top and bottom line beat. But when Microsoft raised their capex forecast in the conference call, the stock gave up its gains, actually finishing the week down 1%. Of course, Amazon and Alphabet both rallied more than 8% last week, despite raising their capital expenditure guidance for the current year. So clearly, Wall Street hasn't completely turned against heightened AI spending. What's the difference here? Simple. I think Amazon and Alphabet both did a much better job of explaining why they need to shell out all that money. For example, during Amazon's conference call, CEO Andy Jassy laid it out for you. Listen to this, quote, "You're going to see us continue to be very aggressive investing in capacity because we see the demand. As fast as we're adding capacity right now, we're monetizing it," end quote. Hey, that makes it feel like they aren't just spending a few extra billion purely for the sake of lighting their money on fire. Then again, a cynic might argue that Amazon and Alphabet got away with their higher capital spending plans because they simply didn't go into as much detail as Meta and Microsoft did. I'm not buying that. I mean, the latter laid out numbers for next year's capex, while Amazon and Alphabet really said they'd be spending more. But I love what the fact that they have the demand. That's all I care about. All in all, though, there's a lot to learn here. Obviously, these huge spending plans are great news for NVIDIA and its fellow suppliers of data center equipment. On the other hand, the fact that Meta sold off so hard on the news of its spending plans might make you want to take a little more cautious approach to the industry as a whole. I am not worried about the AI data center boom, but I do think that the tech titans who don't need to spend as much on AI could be in better shape in this environment. Think of that. Here's the bottom line. While many of the tech titans are spending fortunes on the data center build-out, there are other companies that can be major AI winners without having to spend ungodly amounts to buy money on spending for NVIDIA and building out data centers and paying for electricity to keep the stuff running. Stay tuned, and I'm going to walk you through the ones that are the real winners for 2026. Let's go to Jay in Florida. Jay.
Hey, Jay. Hey, Jim. Good afternoon. I love the show.
Oh, good afternoon. Thank you. Thank you, buddy.
My question is about INTC. Is it too late to go in? Is it a buy still?
It's too late. Money's been made. Let's just be very careful. The stock's had a gigantic move. There are many people who say that there's still so much work to do. You're going up against some very big companies. It's been a huge run. Lip Bhutan has done a terrific job. If I were him, I would raise as much money as possible because there was still so much damage to that balance sheet. The problems aren't over yet. Look, I am not too concerned about the AI data center boom, but I do think the tech titans that are spending less on AI could be in a little better shape right here, or at least they could explain it better. They'll be in great shape, much more mad money ahead. I'm covering those stocks that could benefit or even soar from AI without the massive CapEx spend. Then I think the American consumer can spend some 3 words. I'm going to reveal them later, and all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. Before the break, I pointed out that Wall Street's finally started pushing back against some of the hyperscalers for their massive capital spending commitments towards building out data centers for artificial intelligence. Meta's stock got obliterated. Microsoft initially roared in response to a great quarter, but then it gave it all back when people freaked out about their CapEx budget. But here, you know what? There's a group of companies that can benefit from the rise of AI without having to spend borderline psychotic amounts of money on infrastructure. In this environment, these may be the ones you want to write down. These may be the safest. Take Apple. The other members of the Magnificent Seven that reported last week, the only one I didn't dig into before the break. Meta and Microsoft and Amazon and Alphabet spent fortunes on data centers in order to win the AI race. Apple's looking better and better because they opted out. They're not trying to build the best chatbot, though they are working on improvements to Siri that should arrive by next spring. And they're going to make it a little more personalized. But overall, as far as I can see, this strategy is to do the same thing they did with search. Why not just let somebody else build it and then pay Apple for the privilege of being the default on all their devices? Google reportedly pays them $20 billion per year to be the go-to search engine, which we now know was held up in court as a payment that was totally legit. I bet they can even get more from that from one of the hyperscalers that wants to be the go-to generative AI platform. There's not that much difference between them. It would really help if they had Apple. At times over the past couple of years, Apple's come under fire for not really seeming to have an AI strategy. But as I said repeatedly, they don't need one because they have an installed base of over 2.35 billion active devices, and any of the hyperscalers would happily pay up for access to that user base. Still, one more reason why I always say Apple, own it, don't trade it. Doesn't hurt that these guys reported a magnificent quarter, yet the stock ultimately didn't get much credit for it, but it did run up in advance of the report. Who else can make a fortune from AI without much upfront investment? Well, here's one you haven't thought about at all, and it's Reddit. That's the online message board platform that's become a major force in digital advertising, offering some of the best ad rates and the most targeted audience that's still growing by leaps and bounds. After Reddit reported blowout numbers, we had co-founder and CEO Steve Huffman on the show last Thursday. Not only did Reddit put up nearly 70% revenue growth, their margins have soared. They had a 91% gross margin, 40% adjusted EBITDA margin. That's very impressive for a company that's barely profitable when it came public. A lot of people thought it would never be profitable. There's a reason the stock jumped 7.5% last Friday, though it did give back a bit of that today. The other number that stood out to me for Reddit's report was the company's capital expenditures figures came in at $2.1 million in the third quarter. Yes, that is indeed a million with an M. Here's how Huffman put it when he came on the show.
Look, that's the aim of Reddit. High margin, high efficiency, very low CapEx. And, our aim and what we've learned so far is we can be an AI winner without the AI cost.
See, Reddit's partnering with the chatbots to license its data because that data is essential for training generative AI models. Keep that word in mind. Companies like OpenAI and Google already pay Reddit to license its data, and though this is still a relatively small portion of the business, I think it could grow very big over time. Why? Because many of the other generative AI companies are allegedly using Reddit's data without paying them a dime. So far this year, Reddit's filed a couple of lawsuits against AI companies like Anthropic and Perplexity, deep-pocketed, for using their data without permission. I expect they'll have to make some kind of deal, which will be pure profit. Keep in mind, most of these chatbots rely on Wikipedia and Reddit. Take those data sets away, and they become even less reliable than they already are. And they are reliable enough to use without double checking. Who else could make out like a bandit by licensing their data to the big AI platforms? Hey, how about the New York Times? That's the paper of record, for heaven's sake. The New York Times has already begun to make some of these deals as well. In May, they announced a multi-year licensing agreement with Amazon that would allow Amazon to use their articles to train up AI models. I don't know how much they're getting, but the great lady doesn't need to spend an extra cent to make that money. They're just licensing out what already exists, and they're real smart. And I read their briefs. I like their case. Plus, the Times has this ongoing lawsuit against OpenAI, which they originally brought almost 2 years ago. If they win, then the company could be looking at a significant new revenue stream, not just from OpenAI, but from every other AI platform that will be forced to pay up to train their models on the paper of record. I think they got a very strong case. That said, the New York Times reports on Wednesday. I have no idea how the quarter's going to be, okay? Maybe buy it on weakness. Finally, let me give you one more potential AI winner that doesn't need to spend more money to get there, but has really been moving up a lot, and that's a company called Cloudflare, the cybersecurity company / content delivery network. That looks to be like an enforcer for all the content publishers that are basically getting their data stolen by generative AI platforms. This past summer, Cloudflare announced that it was the first internet infrastructure provider to block AI crawlers from accessing content without permission. In August, when we last had CEO Matthew Prince on the show, he sounded earnest about wanting to help smaller publishers that are getting ripped off by AI companies. He told me that as the world transitions from search engines to answer engines, these publishers are getting hosed because, unlike search engines, AI platforms don't send them traffic. That's why Cloudflare is helping their customers protect themselves from AI data scraping. Without that protection, they cannot get paid. Now, we don't know how much Cloudflare could make from this business, but, man, they reported one excellent set of numbers last week, which is why the stock jumped almost 14% on Friday. It's one of my favorite stocks. Throw in the anti-data scraping opportunity, and they're only going to get more profitable. So here's the bottom line. If Wall Street finally is balking at the big spending for hyperscalers, selling out fortunes for data center build-out, maybe you want to own a company that can profit from artificial intelligence without spending much at all. Apple, Reddit, the New York Times, Cloudflare, all would stand to benefit from the rise of AI without having to pony up billions of dollars. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time for the lightning round. Quick fast from pitfalls on the CNBC TV by self been of course head of time my staff person where to plan this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Joe in Colorado. Joe.
Booyah, Jim.
Booyah, Joe. What's up?
Awesome. Hey, thanks for taking my call. I'm a first-time caller, but I've been listening to you for 20 years, man. You're awesome.
Oh,
thank you so much for all you do.
Thank you very much. Thank you.
Absolutely. Hey, I'm calling about the SAIC. It's a stock I've had for, several years.
I like it. I've known it for a very, very long time. It's an inexpensive stock, and I think it's a buy. Let's go to Joanna in Pennsylvania. Joanna.
Hello, Mr. Cramer. Thank you for taking my call.
Of course.
I have a stock here that's just got me confounded. TerraWolf.
Yeah, it's a Bitcoin mining stock that people think is going to do far more than just Bitcoin. I've got to tell you, I'm a believer. It's pure spec, but I am a believer. Let's go to Donovan in Maryland. Donovan.
Hey, Jim. How are you?
I am good. How are you, Donovan?
I'm good. I want to start by saying shout out to Mr. Marks and Mr. Fair at Stephen Decatur High School.
Absolutely fantastic. Fantastic.
I'm a big risk taker and like to gamble. Shout out RainBet. But the company I was looking at is Nebius Group.
Nebius is a huge look. It's Nebius, IREN, and CoreWeave. Those are the three. They're going to keep getting contracts. If you're in on the day when the stock is down, they get a contract. You're going to make money. What can I say? And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, are corporate earnings finally starting to reveal cracks in the consumer? Cramer is taking a closer look at the state of spending. Next.
Nickel and dime. That's how I think the American consumer feels right now. Everywhere she goes, she feels like she's being charged too much. The problem, though, is that the input costs for so many things have gone haywire, and it's hard to figure out how to get those costs back down. Right now, virtually any stock that relies on consumer spending is doing terribly. Many are deep in bear markets. Doesn't matter how well the CEO says the business is doing. If the consumer has to pay for it and the price has gone up, then the consumer feels like she's been had. Last week, for example, Royal Caribbean, a cruise line that's done incredibly well since the pandemic, reported a quarter that looked good, but the market judged it harshly anyway because the reservation book didn't fill up fast enough. That's supposedly a sign that consumers are getting tired of taking cruises. I know Disney has powerful pricing power as its parks are full, but Wall Street doesn't trust that their pricing can hold up either. On the Comcast conference call last week, there was plenty of buzz about price in the consumer. AbbVie stock is still falling after management talked about slowing medical aesthetic sales. Botox for the face may have finally hit a wall, even though this business had been booming because so many people didn't like their slackened faces after they lost so much weight taking the GLP-1s. I found the AbbVie call particularly jarring because the weaker numbers indicate that rich people aren't spending to keep their faces wrinkle-free. Maybe you can't be too thin after all. Oh, and how about those liquor stocks? Constellation Brands, Michelob, Modelo, and Corona can't seem to get out of their own way. Stocks falling from 221 to 130 this year. Molson Coors, how about 57 to 43? Diageo, 127 to 93. So much for all those different Johnny Walkers. Unfortunately, very few execs seem willing to admit the simple truth that prices have simply gotten too high for so many. And that's why I found it refreshing to read an article in the Las Vegas Review Journal last week, which my writing partner Matt Horween shared with me, about how some of the execs in Las Vegas think things have gotten out of hand. Bill Hornbuckle, the CEO of MGM, told the paper, quote, "When we think about pricing and things that got everyone's attention, whether it be the infamous $26 bottle of water or Starbucks coffee that cost $12, shame on us," end quote. He said his organization is course corrected and suggests that all Vegas needs to follow in his footsteps because tourism's been on the decline. Ooh, that's the biggest shakeup in Vegas since Bugsy Siegel got assassinated. Maybe everybody who deals directly with the consumer needs to cut price, but not every retailer or restaurateur can handle that because their input costs have gone up too. One thing's for certain, Wall Street isn't willing to wait for a cost correction. These two groups are filled with stocks that are in plain old bear markets. It doesn't matter if a restaurant chain is doing well like Restaurant Brands or Darden or doing poorly like Wendy's. It's proving hard for their stocks to find a bottom. Now, I don't want to give up on two entire industries. I'm guessing that after tomorrow's election, either the Democrats or the Republicans will cave in the budget negotiations and the government will be able to reopen. If that happens, then maybe some of the consumer-facing stocks can come back to life. Right now, though, it's important to recognize that things have simply gotten too expensive for many, to the point where the consumer constantly does feel nickeled and dimed. At some point, Wall Street will care about which companies are doing a better job of handling the situation. But for the moment, everybody who deals with the consumer is being painted with the same broad brush. I don't want to abandon the good ones, but the pain may be too hard for most to take. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.